According to Jeremy Grantham, we are in the fourth stock market super bubble in the last 100 years. He says it is getting ready to burst. We have seen a 25% decline in the S&P, but central banks are doing everything they can to calm down inflation without bursting this very large and fragile bubble. The market has certainly declined, but has not yet burst. Whenever this happens, it will not only be the bursting of the fourth super bubble, but will probably also usher in the fourth secular bear market in the last 100 years. I will explain how secular bear markets work. This is a chart that I've shown several times. It's a 150-year chart, and it shows the up and down movements of the stock market during that period of time. It is marked by long-term bull markets and long-term bear markets. The bull markets generally have an upward direction, but they also have, keep in mind, this is 150 years. They have significant dips in them, and some of those dips are considered bear markets, short-term bear markets within a longer-term bull market secular cycle. The reverse is true. So when the market goes down, you see marked by red, these are long-term secular bear markets. They tend to last 10 to 20 years. The last one lasted actually 9, so let's say 9 to 20. The Great Depression was the longest, and it lasted 20. The other two, one before the Great Depression, one after, lasted 14 and 17 years. So generally think in terms of 10 to 20 years that these bear markets last. Inside of that bear market, long-term secular bear market, are short-term cyclical, they're called cyclical, bull markets and bear markets. And they can go for a period of 6 months or more, maybe even a year, up or down in both of them. And by the way, this chart is done on, it's a logarithmic chart, and it is inflation adjusted. So logarithmic and inflation adjusted. So it's a very realistic chart based on percentages and adjusted for inflation. At the very end of the chart, on the very far right, I circled where we are today. This drop represents 2022. So again, because it's a long-term cycle, you can see that small movements don't really affect it a lot. So, but we don't really know yet if we are in a secular long-term bear market, or if this is a correction and a bear market, cyclical bear market inside of this longer-term secular bull market, which has been in place since 2009. I would say this: I believe we are in a secular bear market, that we have entered that territory, but we don't know that except in retrospect. So in time, we will be able to look back and say, yeah, this was the beginning of a secular bear market, or it was not. It is a bear market. The question is it cyclical or is it secular? It feels and looks like it's secular. But again, time will tell. We can look back and determine if that's the case. As I look out from here and see the future, the headwinds, the difficulties with currencies and interest rates and inflation, food issues, supply chain issues, etc., as far as the eye can see, it's hard for me to imagine that we are still entering we're still inside of a growth market, but rather that we are entering or have entered it's hard to believe we're in a bull market, but it feels more like we have entered a bear market. And of course, through the red line that cuts through the middle, the regression line cuts the data down the middle, and you can see how far above that regression line we still are. So not unlike these long-term multi-year secular bear markets, we have a long ways to go if that is the case. Along the way, if that's the case, along the way we're going to have some head fakes that will try to go up for a while, and then we will reverse that and continue on that downward trend if it is in fact a secular bear market. One of the things that goes on in bear markets and bull markets are the change of emotions. And this chart really says this very well. It shows that on the left side, the beginning of the market or the beginning of the cycle, you can see the emotions, the range of emotions that go on during cycles. These could be short-term cycles or they could be long-term cycles, either one. And we experience that now. We saw frankly, in the last, 12 or 13 years, we saw 12 years, let's say, 2009 to 2021. We, generally speaking, were in an uptrending market, and no question you would call that a secular bull market. That contained, we were in a period of optimism, excitement, euphoria. I think of it as the market can do no wrong. It's just going to go up. And if there was this concept of buy the dip, if the market pulls back and you have money, pulls back, 5 or 10%, buy it because it's going to go on back up. That's called buy the dip. And a lot of investors and traders had that mentality. And when you get up to that euphoria stage, I think that's what you see. The 1st of January happened, and the market began its gradual grinding down for the last 9 months, all the way through the month of September. There were some periods where it went up short term, but it just kept getting slammed down and down and down. Never actually capitulating or hitting a very harsh crash, but just a grinding down. When it turns and goes the other way, when it comes down, you see the other kind of emotions that go on: anxiety, fear, panic, and hopelessness. You could even say despair. And then when it starts to go back up again, relieved, and all the way back up to optimism again. So complete cycles. During a bull market, as the market is going up, the blue circles represent the most risk in the market is when people feel the best. When they feel like there's no risk, when it's just going to keep on going, that is when the most risk is in the market. And there is the least worry. You go to the other side, and at the very bottom of the market, when people are throwing in the towel, they're done, they're fed up, they really oftentimes, they don't want to be in the market again. It's really wiped a lot of people out. At that time, there is the most opportunity for making money. The best time to enter the market is when people really don't want to be in the market. And there is the most worry at that point. So when you look at emotions, and a lot of this is generated by media and TV and so forth, when you look at the range of emotions, it is kind of counter-directional or counterintuitive to what you should be doing. So when you feel the best is when you should probably diminish your risk one way or the other. If you invest based on emotion. And then conversely, when the market is at its worst point, that is when hopefully people have money and can and should invest at that point. However, most people don't work this way. So most people stay in the market, they ride it all the way up and they ride it all the way down. So as they ride it down, they didn't get out, they didn't employ some kind of a defensive approach or diminish their risk at the point when they probably should have. So as they start to ride it down, they become more and more fearful, and a lot of times they've hung on too long. And when they get to the bottom, they're very frustrated, they've lost a lot of money, and they still have positions in the market. So what they don't have is cash. If they had raised cash and sold assets when the market was higher, they would have money to invest, and that is more the time to invest. Of course, we don't invest emotionally, we invest mathematically. When these times happen, we tend to get out early, and then our hope is that we get back in early. So far, we've worked pretty well with that. But we've been out of the market for quite a while now, and we're very pleased to be out of the market. But there will come a time when the market conditions are such that we'll re-enter the market, but we want that to be closer to the bottom, and we want to be exiting close to the top. And we want to do it mathematically, not based on emotion, because if you do it based on emotion, or I do it based on emotion, you can be wrong as much as you're right. And you not only have to be right once, you have to be right every time. So if you're right at the top, you also have to be right at the bottom. And if you're going on emotion, it's very hard to do. I want to play a clip by economist Richard Duncan. I follow him, have followed him for a number of years. He's independent and does not work for one of the big banks or big brokerage companies, and tends to be an independent thinker. And this is a 1-minute clip. This is just a few comments from him, and he'll explain what he sees going on in the market.
Last week, the Fed shocked investors when it released new projections showing that it now expects to increase interest rates significantly more than it had planned to do just 3 months ago. If the Fed does push interest rates up in line with these new projections, while at the same time removing hundreds of billions of dollars of liquidity from the financial markets through quantitative tightening, as it's scheduled to do, the chances are high that something is going to break. The stock market and other risky asset classes are likely to experience another sharp leg down. Home prices are also likely to begin falling, with double-digit percentage declines possible across many parts of the country. In addition, the U.S. economy is likely to experience a very hard landing. The financial markets and the U.S. economy are exceptionally vulnerable in this environment of accelerating monetary policy tightening. This video explains why.
Next, I want to play a piece. This is an interview that Joe Kernan did with Stanley Druckenmiller. Stanley Druckenmiller is considered probably one of the most successful investors of our time. He is now, he left the fund that he worked for and is now basically managing his own money. But he has a lot of insights, and because of his success, I want to play this. And he will say that he's not making a prediction about the future of the market, but his track record is admirable. And I think a lot of people, the reason Joe Kernan's interviewing him is because he's looking for the insights from someone as experienced and who has been as successful as Druckenmiller has. So here are his insights based on what he sees as current market conditions.
I will be stunned if we don't have a recession in 23. Don't know the timing, but certainly by the end of 23. I will not be surprised if it's not larger than the so-called average garden variety. And I don't rule out, not my forecast, but I don't rule out something really bad. Why? Because if you look at the liquidity situation that has driven this, we're going to go from all this QE to QT We're following an asset bubble. We've been doing all this running down on the SPR, which is now, that's the Strategic Petroleum Reserve. It's now below 84 levels, even though obviously oil consumption is much higher. We've had a bunch of myopic policies that have actually delayed the liquidity shrinkage. QT has been almost entirely offset by Janet Yellen running down the Treasury savings account. By the way, pretty amazing policy. She could have sold 10 years for under 1% during this time. Instead, she runs down the Treasury savings account. So all that has masked the liquidity shrinkage, but it really comes into full gear. And she can continue this for a while. We can do the SPR for a while, stimulative stuff. But by the first quarter of 23, it kind of goes the other way. So our central case is a hard landing by the end of 23. But I don't know. I've been wrong on a lot of things. I could be wrong on this. But since I do it for a living, that's our forecast, which is a recession in 23.
Now I want to shift. I'm just going to do 2 slides on the economy, 2 things on economics. The first, and this happened this past month, during the month of September, they reported on the inflation, the rate of inflation. When they reported on this, it was a surprise that inflation was as high as it was, because what had happened at that point was that the price of gasoline and fuel had come down. And that's a component of the consumer price index. So they were expecting to see a lower number. And in fact, the number was higher than expected. As soon as that happened, the stock market and bond market sold off. And that's represented by the far right, the red bar, which is the month of August, showing that inflation is in fact still high, and whatever the Federal Reserve has done up to this point has not been enough. And that prompted them, one of the things that prompted the Fed to raise interest rates 3/4 of a point recently was the fact that they don't have it under control yet. The next, and this is a factor in the stock market, and it's a fairly big factor. It's called liquidity. And liquidity has to do with the amount of money in the system, and it's called money supply. There's a term called M2. M2 measures the money supply in our economy, and it's measured in trillions. But the money supply does go up and it goes down. So what's happened is that during this period of recently, in the past few years, the Fed has been buying securities. And of course, they went through this period of lowering interest rates. So what they're doing is stimulating the economy with a greater amount of money supply. Now, they are doing the opposite. They're quantitative tightening. They're raising interest rates, and they are selling securities. They're selling $95 billion per month of mortgage-backed securities and treasuries. So what they're doing, therefore, sucking $95 billion per month out of the economy. The 3 months prior to this, they were sucking half of that out of the economy, $47.5 billion. And they're trying to ease their way into it by cleaning up their balance sheet, but it is not, you can see from this chart that it's coming down, and as a result, we've got a lot of things that are going negative. The stock market, the bond market, the economy, jobs, even some real estate is starting to go more negative than it was, certainly than it was last year and even earlier this year. The flow of funds report through September 30th shows, no surprise, last month, and this year have all been negative. And you'll see this coming up. But as money, therefore, is coming out of conventional equity funds, conventional bond funds, $8.9 billion coming out of conventional equity funds, $10.4 billion coming out of conventional bond funds, and money market funds had an inflow of $6.4 billion. Now, you know that right here I scratch my head. I'm trying to figure out if we've got about $19 billion coming out of equities and bonds and only $6 billion going into money market, where is the money going? We don't know. We really don't know. And I have an opinion, but it's just an opinion. But the direction is away from risk, and that's reflected in the movement of the stock and bond markets this past week and this past month. Okay, this is a chart, a dashboard showing the major indexes. I'll go through these. They are compared to, it's an unusual chart because they are compared to their moving averages. On the right side are 4 dots going across horizontal for each index, the 20, 50, 100, and 200-day moving averages. So what this shows by a red dot is that every single major index, including bonds, are below their all moving averages. And when I say bonds, I mean government bonds. So you see, and then when you go across the numbers, each index is listed down the page. You go across, there are 5 sets of numbers. They're all negative. These represent Friday, last week, the month of September, and year to date. So I'm looking at, and the quarter and year to date. So I'm looking at the year to date numbers. So when you go across 5 columns, you see of red numbers, you see the year to date numbers. So beginning at the top, the S&P 500, year to date, down, the Dow, down 20%. The S&P 500 down almost 25%, 24.8. IWM, the Russell 2000 Small Cap Index, down 25. Emerging markets down 28. Developed markets down 28. The long-term government bond down 30%. Wow, down 30%. I thought this was supposed to go up when equities went down. It didn't happen. We're in a new paradigm, and it's not working well for conventional portfolios. And this is one of the reasons why. The NASDAQ 100 down 32%. So a very, very harsh year. And I don't know where it's going to end by the end of the year, but year to date through 9 months, that's where it is. And so this article that said that portfolios, 60-40 portfolios, are on track for their worst year since 1936. And so when people who are in conventional portfolios, conventional investing, are feeling pain somewhere in the 20s, somewhere between 20% and 30%, most of them, let's say 25% is the average, that is a lot of pain because it came out of nowhere. There was no preparation in most cases, and this set of data shows that. When I take the S&P 500 and break it apart into its 11 sectors, going from energy all the way down to retail at the bottom, you can see that in all instances, 20, 50, 100, and 200-day moving averages, all of these sectors are below all of those moving averages. The year-to-date, and again, this is the 4th column from the left, the 4th column over year-to-date, energy was up like 42% at its height year-to-date, And it's because oil prices and gas prices have come down in the month of September. That came down quite a bit from 42 down to 29%. After that, all of the other sectors are negative, starting with consumer staples down 13% and going all the way to the bottom with retail down 37%. But many of them are down, somewhere in 20 to 30%. And by the way, last week, there are 44 red dots. Last week, there were 44 red dots. So this has been a very harsh trend for conventional investors. Okay, shifting to charts now. It's not necessarily predictive. I'm not saying this is the way to invest, really. It just explains where we are and where we have been. So when you look at the S&P 500 over a 12-month period of time, this is a weekly chart. One move equals 1 week. 1 week of action by the S&P 500. The black line shows the trend of that. There's ups and downs, probably a lot of ups, a lot of downs. But over that period of time, it is in a downward trajectory. And you can see the last couple of weeks down pretty harshly. And I think that's actually 3 weeks. That's down harshly at the end. Then I take and I do a relative strength chart, taking the growth stocks in the S&P 500 as the numerator and the value stocks in the S&P 500 as the denominator, and plot that ratio. That ratio, you can see that, again, the trend is down, which tells you that value, the denominator, is in favor. When it goes up, that tells you that the numerator is in favor. So, but the long-term trend is value is more in favor than growth at this point, and seems to even be continuing to trend down. Then I take the small cap Russell 2000 index, IWM, and establish it as the numerator, and the S&P 500 SPY as the denominator, which shows the relationship, the relative strength of small cap versus large cap. If it is going up, this favors small cap. If it is going down, it favors large cap. They could both, and did both, go down, but the question was which went down the most. And in this example, you can see from the black line over that period of time, this is a 24-month period, so for about 18 months, small cap went down more, quite a bit more, than large cap. Get away from the relative strength charts, the comparison charts, and just go with an absolute chart, and the absolute chart of the government bonds. And these are used. They're used in most portfolios and most conventional portfolios. Of course, I've said before we don't use them, but a lot of traditional financial advisors do use them, and along with some other bonds. But I thought I would show the direction of I'm going to do something different this time. I'm going to show the long-term government bond, the intermediate government bond, and the short-term government bond. So you'll see all of them. I'm not just picking on the long-term government bond to pick on them. I'm just trying to illustrate that government bonds are under pressure. So this is a 30-month chart. I do this so that I can show you both trends. Actually, there's 2 or 3 trends here. The trend down once, and then in the past year, and then the current trend down, and look how steep that is going at the very end. It continues to go down sharply. And in between, there was a period of time where they actually went up. But the long-term trend is down. When I jump over to the intermediate term, this is it says TLT. This should be IEF. IEF, the intermediate term bond, same thing. It just behaved a little differently. But the latest trend is even sharper down. The amount of drop is not as much as the long term, but the correlation and the direction is similar. And then I go to the short-term government bond, SHY, and this is the 1 to 3 year bond. And look at it. Wow. It's the drop is even steeper. So they all have that direction. They're all going down. They'll have a long-term trend down. Gold, 48-month chart, so it's 4 years. You can see that about the first half of the chart, gold was going up. And then, generally speaking, it's been going sideways to slightly down. Last week it went down. Monday, this week, it's going up at this point, somewhat. And so we don't know if that's going to stay. It's hit a bottom or not, but the trend for the last couple of years is in a downward direction. Silver is generally correlated with gold, but it tends to be more erratic and moves more dynamically than gold does. So I put this on a 48-month chart so you could see the direction. When it goes up, it really goes up. When it goes down, it really goes down. And at the end, there is a direction that it wants to go back up. As of Monday this week, it is up 7% on Monday. So that's a big move. So I don't know if that's going to start to change this direction or not, but for the last couple of years, you'd say that the direction clearly is down. When I plot those, the ETF, the SLV, and GLD, I plotted it over 48 months. You can see that there are periods, I put these arrows here to show you, there are periods where going down, gold is in favor because it's a numerator, it's a denominator. When it goes up, that favors the numerator, which is SLV, representing silver. And then on the right side, the last move down is, again, favoring GLD or gold over silver. So we really, unless we are actually beginning a new trend up, that it really hasn't broken the trend line at this point. The volatility chart, last week was a very negative week in the stock market and the bond market, as you saw. But there were no days that were crashing days, cataclysmic days. It just ground its way down every day. It tried to go up and it would go back down. And the volatility index continued to go up, but it did not go up sharply. If there is a crashing component to the Dow loses 2,000 points in a day or something, this will really spike up. But with just a general market move down, it is pushing the volatility index up. And I marked 24 on this index to show you where I put the baseline, and you can see how far above that the index is. Asbury Research does 6 metrics, indicators called the Asbury 6. For some time this month, particularly the latter half of this past month, these have all been negative and, of course, still are negative. The cross-asset relative performance. This is comparing one asset to another, showing which ones are more in favor. Now, both can be going up, and it's going to compare them, which would say which is going up the most. Both could be down, comparing them, which is going down the least. So it's not defining the direction, it's just showing which one is, quote, outperforming or is losing less money. So bonds compared to stocks. Now these are more corporate bonds, not government bonds. So represented by the ETF, AGG. So corporate bonds outperforming stocks or going down less. Low volatility stocks doing better than high volatility, small cap, as we saw earlier, doing better than large cap, measured by the last week, the last month, and the last quarter in those three columns. And the Dow versus the S&P, that's been pretty consistent this year. The Dow, generally speaking, has gone down, but it's gone down less than the S&P, and it has certainly gone down a lot less than the NASDAQ 100, and has gone down a lot less than the foreign stocks. S&P 500 compared to the NASDAQ 100, you saw that earlier, the NASDAQ 100 has lost more, so S&P 500 lost less. Value over growth, both are down, but value has gone down less. Bonds, government bonds, better or have outperformed LQD, which is the corporate bonds, and in all three time periods, and the short-term bonds have outperformed or gone down less than the long-term bonds. The U.S. versus the world. So this is an interesting paradox. Money, because of the strength of our economy relative to others. China is struggling, Europe is struggling, UK is definitely struggling, Japan is struggling, and the U.S. relative to those economies is doing better. And so, but what's interesting is that the ETFs for these countries compared to the S&P 500 are actually outperforming the U.S. The U.S. is not outperforming a single one of them enough to get a green box. And some of these that are outperforming the U.S. are emerging countries, underdeveloped countries. For example, including Peru, Malaysia, Mexico, Brazil, India. You know, those are not typically viewed as first world countries. So, but there are quite a few here that are outperforming the U.S. from a stock market standpoint. So the economy may be doing better in the U.S., but it is not showing up in the performance of the stocks. Buffett indicator still shows as fairly valued. The ratio has been coming down in the past few weeks from 175%. Now it's down to 151%. And I think that's 3 or 4 weeks now. And so this is as of last week. The market value of the U.S. is $38 trillion. And the economic output, the gross domestic product, is $25 trillion. And so from a relative standpoint over time, that's called fairly valued. The price through last week, or for last week, price of gold was up 1.1%, and silver was up 0.7% over the previous week. So not enough to say there's a trend here yet. On the upside, there is still, generally speaking, it's a downtrending market for precious metals. I want to show you a brief video, a few minutes. It has nothing to do with the stock market. It has nothing to do with the economy. It's just a cool video I saw of this young man. He's 12 years old, and he's farming his parents' farm and selling the produce that he raises on the farm. It's a pretty cool story, and I couldn't resist the idea of just showing it to you. So if you'll just watch this, I think it'll make you feel better. There's a lot of negative news out there, and this was a piece of good news, I thought. Here you go.
If you're driving around Auburn, you might pass a farm stand. And while the stand looks small, the work it takes to keep it up is a big undertaking.
The person behind growing, raising, and caring for the animals and the products that he eventually sells is a 12-year-old. News Center Maine's Jackie Mundry introduces us to Brandon Nadeau.
He might not be able to drive a car for 4 more years, but 12-year-old Brandon Nadeau always knew he wanted to be behind the wheel of a tractor. So 2 years ago, he started his first farm stand.
I've been farming my whole life. As long as I can remember, I was on his lap steering the tractors and running the bucket.
I turn around, I trip over him. He was right there.
Dan Herrick has always had a farm at his home, but never more than a way to feed his family. Now, Braden essentially runs the family farm himself and has grown it even in the last few years, opening a farm stand for the community.
Cabbage, scallions, and more zucchini.
He starts his vegetables from seed.
Get this itty bitty seed and it turns into something like that, which is huge. And I just think that's amazing.
And raises livestock,
My cows.
turkeys and chickens for meat and eggs, and pigs for both meat and breeding. Braden works 12 hours a day, 7 days a week in the summer. He's outgrown the original farm stand he and his grandpa made 2 years ago and made enough money to buy a new one. He also has invested in tools for the farm and learned how to fix things if and when they break.
There ought to be more 12-year-olds like him.
What are some of your friends doing in the summer?
Playing video games.
He says he thinks he's learning a lot more out in the fields than he would be sitting in front of a TV.
I think it's better because you get more of an experience and it's life preparation, I guess.
It teaches him business. It teaches him how to work. It teaches him to stay out of trouble. It teaches him where food comes from. And without farmers, there's no food.
With the help of his grandparents, he has learned how to farm and raise animals. He also has homemade zucchini bread and zucchini relish, made by members of his family and the Auburn community, with vegetables straight from his garden. In Auburn, Jackie Mundry, News Center, Maine.
Okay, I have to apologize. I said 0 for 2 on saying Braden Nadeau correctly. So Braden Nadeau. Braden picks fresh vegetables every day for his farm stand. You can visit him at 470 Hatch Road in Auburn.
I'm glad the stock market closes on the weekend. It gives my fingernails a chance to grow back. With that, I appreciate you watching. If you have comments or questions, leave them in the comments section. I'll try to respond to them. And certainly if you want to, feel free to reach out. I'll be glad to talk with you. Thank you.